Welcome to today's Morning Report with me, Richard Perry, market analyst at Hantec Markets on Friday the 29th of July. European trading session fairly muted but mildly positive. But the big movement overnight has been in the yen. The yen has strengthened significantly. That's come on the back of the Bank of Japan disappointing markets in its monetary policy. There had been quite significant measures that the Bank of Japan could have taken. But the expectations were not met. The Bank of Japan could have increased the JGB purchases from 80 trillion yen. They could have also further cut the deposit rate back to 20 basis points or even 30 basis points negative. And also the potential in the very sort of extreme possibility was for the discussion of helicopter money. But in the event it did nothing really apart from extend the ETF purchases from 3.3 trillion yen per year to 6 trillion yen, and subsequently the yen has strengthened significantly. Across all the yen pairs there have been big moves, but other than that there's not a great deal of movement going on at the moment. There's some mild dollar strength, mild dollar weakness that's just pulling the dollar trade weighted slightly lower. I mean the majority of that movement is coming through the loss on dollar yen, but in terms of the other forex majors, you're seeing sort of the euro mildly higher, the sterling mildly higher, and it's not really a huge amount of movement that we're getting. But all this dollar weakness continues to happen in the wake of the Fed on Wednesday. But the one key factor is that oil continues to fall. Now that's been falling for 6 days straight now, and also this is now entered bear market territory from 51.67 down to currently around $41. That is more than 20% correction, or 20% downside I should say, and that is bear market territory, so that's not looking all that great in terms of where the oil price is going. It doesn't really want to stop at the moment. In terms of where we're looking at on the trading today, well, we've got a little bit of flash data for the Eurozone, CPI, and also the first reading of GDP. Now let me just show you what the expectations are. Run through that. Eurozone, here we go. The the preliminary version of Q2 GDP expected to come in at 0.3%. In terms of inflation, this is all at 10 o'clock by the way. In terms of inflation, staying at 0.1% on the inflation. That's where it was last month. And that sort of takes us into the afternoon, whereby we've got the US GDP, advanced GDP for Q2, expected to come in at 2.6%. Now this is interesting because we have had yesterday the Atlanta Fed giving its GDP now forecast, and it's actually cut it back from 2.3% for Q2 to 1.8% now. That would suggest that today's GDP is, if it comes in at 2.6%, is likely to be is likely to be revised lower, so watch out for that. So you may not get too much of an uplift on the dollar on the back of that. You've also got Michigan sentiment this afternoon. It's expected to be 90.5, which is unfortunately Reuters gives the flash reading rather than the final reading from last month, and the final reading of last month was 89.5. So it's expected to mildly improve from that. But that takes me to my chart of the day, which is the DAX. Now we have had an interesting move on the DAX because we've had this strong run higher, gapped up on Wednesday. But look at this this candle that we had yesterday. That is not only a bearish engulfing candle, but it's also a shooting star, and it also closed the gap at 10.275, basically closing bang on that level. Now I would say that that is a corrective signal. You've had this unwinding move, you're back into this resistance. I've been talking about this resistance band 10.120 up towards sort of the fib level, which is at 10.372, which is the 50% retracement of the big bull market. I'll show you actually the big bull market run. That massive bull market run of 2014 into 2015. 50% fib level has often been used as a pivot level for the big corrections and rallies. That has often been used. So I would say that that is around about where we're sort of coming into. That happened in June, and pretty much caught the late June high as well. And I think that's a big resistance level now. And the fact that we're getting this sort of corrective bearish engulfing / shooting star candle yesterday would suggest that I think this momentum could be running out of this chart. You're seeing the RSI around 60, pretty much where the previous rallies have failed. Stochastics beginning to roll over now. Let me show you the hourly chart, whereby we've had this run higher. We've now started to break this uptrend. Although it's rallied a bit today, it started to break the uptrend. You also saw a move back below 50 on the RSI on the hourly yesterday. Again, it has recovered a slight amount, but these are all warning signals, I would say, and certainly in the fact that we've also had this this candle yesterday, it suggests that there is a little bit of concern whether the rally is going to continue. Yes, it's sort of up again today, 70, 80 ticks higher. But again, this is into a big band of resistance, and I think that there will be some concern whether this DAX run higher can continue now. So it is certainly a warning sign for the rally. In terms of your supports, you'd say obviously yesterday's closing low, 10.275, is the initial support with that gap, but also 10.150 as well, which is a reaction low from the 26th of July. So a few levels for you to work with there. The resistance comes in 10.381, which interestingly was mildly above this reaction high, 10.365, but also the that 50% fib level of 10.373. So I wish you good luck in your trading on the DAX today, and I will speak to you later. Thank you.